how do you sort of think about the market as it is today and how it was when you started investing in the VC asset class, right? So if you were to look at the Iran fund, and then if you look at our newest fund, how has the market sort of changed in between, and then sort of rechanged again, I think, to an extent
Yeah,
as well.
yeah. So Iran was a very unique case. I mean, it's uh, basically in Iran, we started in 2016, and in total we invested around $5 million to start two companies.
Yep.
Where, let's say, we were founding investors. There was a co-founder that largely was operating CEO. I was doing 80% of the work, and we did what was helpful to get the company up and running. Then brought it the investors to kind of, again, give it a permanency, 2-3 years of runway to kind of run. And on that 5 million invested, and one is an auto vertical, and the other was financial supermarket, right? In online insurance sales aggregator. We built kind of two businesses that today do about $120 million in revenue, and the category leaders, profitable, so on and so forth. That was a very unique view and a unique insight, because basically we didn't have competition, because ultimately sanctions came on the country. And that what we learned was actually in the intervening years, we experienced 80% currency devaluation, right? I mean, shit got crazy. But largely the companies, because they were operating in large areas, and their models were just much more efficient, and so on and so forth. Even in those years, they were growing revenues at least 1.5x in dollars year on year. Okay, that's quite interesting. And you say, okay, deep market, can monetize throughout the cycle, can grow throughout the cycle, but if managed deliberately, right? That was the heuristic overwhelmingly from that experience that we took away. And then you go into saying, okay, I'm implementing this model in a handful of more countries. But that was like supercharged. And I was like, what is going on here? There's just money floating everywhere. Any which way, people were getting funded. And it's unfortunate to see, and it's easy to say this after the fact and trying to sound like, of course, you're in the game, you see that it's going on, you have to play the game. I mean, it's you try not to do stupid stuff, but you can't be out of the market not investing. But a lot of stuff that probably shouldn't have been funded got funded. I mean, it's just, but this is the nature of the game. I mean, again, if you're playing a 20-30 year thing, there are cycles. Liquidity will come, liquidity will go. The economy will go up, the economy will go down. At some point in the 10 years, you'll have some form of political crisis or an economic crisis. Probability entails that will be the case. It's perfectly fine that it happens. Just be prepared for it. Like, create your business to be prepared for it. It's just, you can't fool yourself into thinking that, yes, in your presentation, the slide shows kind of a linear GDP growth rate, a linear kind of, the reality is not that. Don't fool yourself to think that is, and don't build your models to think that that's what it's going to be. Don't fine tune your, just prepare for the reality of what it is. Right? Try to have liquidity always. Try to understand base level economics. What does it take to get your company base level profitable? And how do I build up an analytical dashboard across everything that I need to optimize to know how to tweak it through the cycle and manage your liquidity effectively, right? When times are good, as they were the past few years, be aggressive, get liquidity on your own terms, the best terms that you can. And that doesn't mean very high valuations, by the way. It means finding the best investors, right? Because high valuation basically means you're setting a very high expectation of what you're there to achieve, and you're unnecessarily putting stress on yourself. It largely breaks companies. It doesn't make them better. But use those periods to find the best investors that you can find, and build up your balance sheet so that when inevitably things go a little bit difficult and your competitors go away, then you get aggressive and can consolidate, right? Not to step away when the whole liquidity in the market is going away. That's the time to step down and be as aggressive as you can, because that's really a time to consolidate. That's what I learned in Iran. You need to be prepared to be counter-cyclical in emerging markets, because if you can, and that cyclicality exists in high velocity, you will over a 10-year period just consistently gain market share, economically efficiently, and because you have distribution advantage, because you're technology native, you'll be a beast of a business. I would love to be an associate of any business like that. It's just cool to see. It's cool seeing it being built. It should be built, right?
Yeah,